I'm wondering, you were talking about how the real issue is credit being constrained. How much of this is all priced in, though, already, given how decimated regional bank stocks have been?
Yeah, well, once again, I'm more focused on the impact on the broader economy. Okay, so you could also say that small caps have underperformed for part of that reason. Okay, but we do have a refunding need over the next 12 to 24 months across the broader economy. Even these are private companies too. So to me, that's the thing to watch. We have C&I loan growth now, which is basically flat on a year-over-year basis. Does that go into negative territory? That would be my main concern. Now, maybe that changes. Maybe these write-offs are going to be the catalyst to get regional banks to say, okay, we've cleared the decks, and now we can start lending again. That's a possibility. But this is a live sort of situation that's going to weigh through earnings, and it's another reason why we're just going to be slow in terms of making that move to small cap
Herman,
stocks.
When you analyze some of the underlyings in the balance sheets, do you find that loans are really slowing and that they are having some sort of constraints in how much they can extend?
Yeah, so in the fourth quarter reporting for the regionals, loans were flat across the board. And really, that's a function of banks have pulled back a little bit in terms of shoring up their capital in their balance sheet. And second, it's not a lot of loan demand given where interest rates are. So across the board, management teams have talked about less demand from business borrowers because of high rates and less need to invest and being a bit more cautious from their commercial borrowers.
Since the pandemic, Bramo, there's just been this feeling that ultimately we're not going to see the credit stress we would see in a normal cycle because of these massive transfers we saw from the Treasury to individual balance sheets, household balance sheets, super strong. We saw the same thing with corporate balance sheets as well. They termed out all this debt, super low interest rates. Do you think, Mike, that we could get through a cycle without credit stress? And I think that's why we keep going back to commercial real estate, because it's this one part of credit which we can identify as a problem area. Do you think it is the problem area to focus on?
No, I don't. I mean, I think, look, commercial real estate usually is a, kick the can type situation. I mean, we had probably a much bigger CRE problem in the 80s. It took 12 years. I mean, we had two kind of, RTC 1, RTC 2. I mean, so my guess is it's going to be a situation where, once again, it just constrains the ability for the banks that have these loans to lend to other businesses. Now, your other question, I think you laid it out right, which is that there was just so much savings created in the pandemic that has allowed the consumer to avoid the typical kind of credit cycle, and because they termed out their debt. Now that may morph itself. Now, look, the cycle's not over, right? So eventually there will be a credit cycle. Okay, is it this year or is it 3 years from now? That's what we don't know. But we're moving in that direction. In other words, we're past the midpoint, right? Credit situation, credit conditions are tight. They're tight. So that's late cycle, and that's why we think the quality trade is still the right place to be.
You mentioned the banks. Let's just sit there just for one further step. It's going to hinder their ability to finance the economy. Got that. That also means that it's going to be a massive headwind to profitability, surely, for the sector. Would you extrapolate that right out through the whole banking sector, or just for a small group of banks, regional banks, smaller banks?
Oh, no, I mean, the market's been really efficient. And I mean, not just in the banking sector, it's like all over the place, right? I mean, this is why the Mag 7 did so well last year. They were the only companies really showing positive earnings revisions. We have the data. I mean, so I think the market has done a really good job of idiosyncratic risks are being priced. To your question earlier, is it fully priced? Well, it's getting priced. You know what I mean? But stock by stock. It's not systemic, and we're going to see more of these. I don't know which ones, but there's going to be more situations where there's going to be some winners and there's going to be some losers, and I think that continues.
So, Herman, let's put some ideas around the idiosyncrasy. I'll get my words out, of the moment. Sure. We were just talking about $100 billion in assets being the threshold for some new regulation that could force some of these write-downs. How many banks are on the precipice of that $100 billion in asset kind of level?
Right. So there's going to be two new banks that are going through the stress test this year. New York Community, which bought Signature Bank, and First Citizens, which bought SVB. So those are going to be new participants. First Citizens has a much higher capital ratio versus New York Community. So it is in a bit of a better standing heading into the stress test. And then there's a couple banks like Comerica and Zions that are in that 85 to 90 billion range. And what I would say is that they're not really growing their balance sheet at this point in the cycle. And so they have some runway, maybe 2 or 3 years before they pass over. So they've got more time to develop their systems and processes before they undergo the stress test.
Herman, good to see you.
Thank you.
Herman Chan of Bloomberg Intelligence. Got some time for some final words with Mike Wilson and Morgan Stanley. Mike, you mentioned this a little bit earlier in the conversation. Let's build on it. International. It's just felt like that the only game in town has been US tech stocks and Japanese equities. I think someone said that on the program
Yep.
yesterday. Does anything else take your interest on the international stage?
Well, I mean, Japan is international. Yes, that has been our favorite region for the last couple of years. But a lot of that's currency. So I think the risk on the Japanese trade probably is currency, and that usually does move markets. So if the Fed gets more lenient this year, right, the dollar will probably weaken at some point. The question is which currency is the beneficiary of that? That's going to be a big switch. Usually that's good for EM broadly, and China has its own kind of story. So EM, I think, is going to be idiosyncratic as well, but I do think EM is the place to be when the dollar starts weakening, but we're not there yet.
Where does Europe fit in?
Europe is Europe. I mean, it's just not that exciting. They're kind of hovering around recession. They're not in it. They're not out of it. It's just low growth, unexciting. I mean, if there's things going on around the world, people choose to go somewhere else. I don't see why that changes. I just don't see that changing.